Welcome to the Birchwood Capital 2026 Spring Presentation. As always, our plan for this video is to remind our clients why we invest the way that we do and touch on common questions we've gotten in recent months. Let's jump in. Like I said, we'll walk through the Birchwood investment philosophy with the key principles being long-term, diversified index fund approach. After that, we'll touch on questions and concerns that we've heard from clients in recent months on things like owning bonds, market crashes, valuation, concentration, and geopolitics. We'll touch on each of those in detail. So the first principle for Birchwood's investing philosophy is long-term time horizon. I thought this quote from Peter Lynch summed it up pretty well. Far more money has been lost by investors trying to anticipate corrections or trying to time the market than has been lost in the corrections themselves. And if you look at the red line, which is the S&P 500 since 1979, you'll see how, yes, there are dips when things go wrong, but you'll notice how the lows for each dip get higher and higher over time, which show the danger and the foolishness of waiting for a big dip to buy in. And consistent with our long-term approach to investing, $10,000 invested in 1979 would be worth $1.4 million today if left untouched. So our thinking is, rather than trying to make short-term calls or tactical trades, we try really hard to buy and hold because we think that's a superior strategy over time. Another slide on long-term time horizons. This is my favorite chart to show the danger of trying to trade around things and trying to time the market. If you miss the 10 best days over the past 20 years, so a very small fraction of all the days, you had 50% less ending wealth. So $10,000 invested 20 years ago in the S&P 500 would be $80,000 today. If you miss the 10 best days over 20 years, you'd have less than half the money. So wow, keep that in mind when you're tempted to say, oh, let me just sell now and buy back in later, because missing a few good days really impacts your long-term returns in a negative way. So long-term time horizons, number one. Diversification is number two. We think staying diversified matters a lot. Historically, most of the wealth created by the U.S. stock market has been driven by very few companies, like less than 10% over time. And our thinking is if you own all the companies through something like a diversified index fund, you're guaranteed to own all the biggest winners. In fact, 40% of the 3,000 largest companies since 1980 have lost at least 70% of their value and never recovered, which in our minds shows the danger of trying to pick winners and losers because there's a pretty good chance that the companies you're picking are going to do very badly. But by owning the basket, you own all the big winners, which drives strong long-term returns. Recent examples of big companies that have done poorly were GM, which reached number 4 in the S&P 500 in 1980 before filing for bankruptcy in 2009, and Lucent, which reached number 7 at the peak of the dot-com bubble before dropping by 97%. So again, we like owning the basket and owning all the big winners, even if you have to own some stinkers, because the long-term returns for that strategy have been very, very good over time. And we think the principle of diversification applies geographically as well. The U.S. stock market has outperformed any other country significantly since 2010. But that may not hold forever. We think it makes sense to have exposure to companies based overseas, and I thought this quote from Charles Ellis's book illustrated the point very well. Why limit your car company exposure to Detroit? Why not add Honda and Toyota? With the point being, there are great companies that are based outside the U.S. Birchwood loves the U.S. We hope the U.S. continues to do well, and we wouldn't hate it if the U.S. continued to outperform, but we want to be prepared for a scenario where that doesn't happen and international companies do better. One more slide on diversification. Real estate investment trusts, or REITs, are effectively publicly traded landlords, so they provide a cheap, cost-effective way to own real estate in your portfolio. Since 1971, REITs have generated 10.8% annualized returns versus 11.1% for the S&P 500, so pretty comparable long-term returns. Over the past 10 years, however, REITs have underperformed significantly, lagging the S&P 500 by 9% per year. My point is not that we should strategically or tactically increase REIT exposure for clients. The point is that there have been long periods of time where REITs did better, followed by long periods of time where stocks did better. And this doesn't have to be a turning point for the next 10 years, but patient investors have been rewarded by history for owning different assets which do better at different times. Principle number 3 for Birchwood investing philosophy is using index funds. We use them because they beat the vast majority of active managers or people who try and pick stocks to beat their benchmarks and beat the index funds. The data in the green boxes from S&P Global, which is published twice a year, shows active funds underperforming the S&P 500. So as you'll see, the vast majority of people who try and beat their benchmarks or index funds tend to underperform and fail to meet their mandate. So on a one-year basis, 79% of funds that tried to beat the S&P 500 failed to do so. And you'll see how the percentages increase as you get further and further out, such that 20+ year time horizons have very few stock pickers able to beat their benchmarks. Because of that, we think actually owning the index fund and accepting the market return puts us in the top decile of money managers. One last slide on our principles here before we get into common questions from clients. Control the controllables. We think rather than trying to pick stocks like the last slide showed or active managers, we believe we add a lot more value for clients by focusing on things like this that we can control, keeping costs low, including fees and taxes, which index funds are great for. In-depth tax planning and helping clients save on their taxes with all kinds of strategies. Regular portfolio rebalancing. So we use tolerance bands to say, hey, if your portfolio gets out of our target ranges for asset allocation, we will trade to rebalance it, which mechanically helps us buy low and sell high. Maintaining diversification, like we talked about, having portfolio withdrawal strategies that minimize taxes and help clients maximize their wealth, as well as lots of nuts and bolts like charitable giving in a tax-efficient manner, estate planning and having all the documents prepared, and insurance costs where we can save clients a lot of money on P&C insurance as well as life insurance. Now getting into some questions we've gotten recently from clients. The first question I wanted to touch on, why do we own bonds? So a client asked this a few months ago, and this question tends to pop up after periods of time when stocks have done very well. U.S. government bonds, as you'll see by the gray chart in the line graph, have provided 1.6% real yield for the past 68 years. So think of that gray bar as saying, hey, if inflation this year is 2%, well, I'm making 3.6% by owning bonds. The point is, bonds have provided real return, which drive the purchasing power of any portfolio higher over time, which is a great place to start when you're thinking about owning any asset, including bonds. Another reason we like owning bonds is that there have been long periods of time where they have provided better returns than stocks. So this graph shows how returns have stacked up since the year 1996. And I want you to focus on the red box, which shows the period from 2000 through 2017. This was a 17-year period where bonds actually did better than stocks. And given the possibility of this happening again, we like diversifying portfolios into stocks and bonds, especially for clients in retirement. Another reason we want clients to own bonds is something called sequence of return risk. This just means that for someone who's living off their portfolio and taking withdrawals on an annual basis, the returns for the portfolio in the early years matter a lot for how sustainable those withdrawals will be over the long term. So look at these three different scenarios, the purple, the gray, and the green. Keep in mind, over this entire 30-year time horizon, the annual average return for each of these portfolios is 5%. Focusing on the graph, let's start with the bar charts on the bottom. So the purple bars are much higher in the first few years, while year one for the green portfolio is painful, down almost 20%. Let's check out how this impacts sustainability of withdrawals. If you look at the line graph on the top, because of that bad first year, the green portfolio actually runs out of money in less than 25 years. And then if you look at the purple line up top, year 30, you have $500,000 more than you started with because the early years were positive while the later years were bad. This chart illustrates the importance of sequence of return risk, and we think bonds really help mitigate this risk a lot. One more slide on bond investing. We use U.S. Treasury bonds for fixed income because they're simple and viewed as some of the safest assets in the world. So the red circle on this chart shows where U.S. Treasury bonds are located on the rating scale, towards the top. As you move from left to right, you'll see the gap starts to widen between the white bars and the black bars. The white bars are the yield offered by bonds at various levels of risk. So the highest risk bonds will advertise rates of 10 to 15% or higher on interest being paid to the bondholder. The black bar is the net return realized by the bondholder in that category. So the difference being the losses of companies that are unable to pay those bond payments because they go into default. Rather than taking higher volatility by owning higher risk bonds, we think clients would be much better served to simply increase their equity exposure rather than chase what Rasmussen calls fool's yield offered by higher risk bonds. Another question we've gotten from clients is whether there's about to be a market crash. I thought this was a helpful opportunity to use this chart from a book by Kyla Scanlon to show how the news can skew our perception of reality. This study from 2022 shows how headlines from mainstream news media outlets have increasing levels of fear, anger, disgust, and sadness. The study was not specific to finance news, but I think it definitely applies to mainstream finance media sources as well. I share this chart to remind you that finance news media has an incentive to keep your attention, which is not always the same thing as helping you make informed, balanced, long-term decisions. And here's a sample of headlines just from 2025. Wall Street Journal on March 6th, the recession trade is back on Wall Street. CNBC on August 12th. Wall Street strategists warn stocks could face a correction after strong run. New York Times on September 5th. Wall Street's rally faces new doubts. And lastly, Financial Times on December 2nd. UK pension funds dump US equities on fears of AI bubble. Notice the language and the bias in each of these headlines. I share these to show you the news media is not always trying to help you make the best long-term investing decision. They're focused on keeping your attention so that they can sell more ad space. They do helpful reporting and provide helpful analysis, but we must always keep their incentives in mind. Another line of questioning we've gotten from clients recently is the valuation of US stocks. While valuation levels are certainly elevated today versus historical averages, that doesn't necessarily mean bad things will happen, especially if you have a long-term time horizon. The blue line shows price to earnings ratio using last 12 months earnings. So that's today's stock prices divided by the earnings generated by companies for the past 12 months. Looking at the chart, you'll see today's level in the mid to high 20s is not that different from where the valuation was in 1992. And you'll see with the bullet there on the slide, if you invested in 1992, you're up over 2,000%. So if you held out from investing in 1992 because you were worried about valuation, you've missed a very strong run. Another concern we've heard from clients is the level of concentration in the US stock market, including the S&P 500 in particular. Again, I think it's useful to look back and see if there is historical precedent for how things are today. 1987 was a time when the level of concentration was in a similar zone to where it is today. So the top 5 companies in the S&P 500 are just over 25%, which is where they were in 1987 as well. Annualized return starting in 1987 over the following 5, 10, and 20 years was 8%, 14%, and 10%. And you'll see that those returns occurred while the concentration levels came down. So the level of concentration being higher today is not necessarily a bearish indicator if we look back at history. And one last set of questions we've gotten very recently is regarding geopolitics and how the US war with Iran could impact portfolios. In the past, any crisis like the US invasion of Iran has created a great buying opportunity, and I'll show 2 recent examples. Since 9/11, which obviously was very scary and tragic for many reasons, the S&P 500 is up almost 10x. Since Russia invaded Ukraine as recently as 2022, the S&P is up over 60%. So while you can see dips associated with these headlines when things get scary and people get confused and uncertainty increases, if you zoom out and focus on the long term, these are great buying opportunities. While there tends to be short-term pain from events like the US invasion of Iran, there are also long-term rewards for stepping in and buying when things are scary, as you can see in this chart. So that wraps up my presentation today. We look forward to our client meetings over the next few weeks. And for anyone else who wants to learn more or reach out, check out our website, our newsletter, and our YouTube channel. Thanks.